Hello, Facebook land. Yes, it is your roving realtor, Bon Vivant. And today, not disembodied voice, doing a Facebook Live. I am here with Evor Vattuone, Aspire Planning Associates.
Correct.
CFP.
Right.
Certified Financial Planner.
That's right.
And where are you located, Evor?
We have three primary locations: Walnut Creek, Cupertino, and San Mateo.
Oh, wow.
Yeah.
That's good.
Yeah.
I think we got something for everybody here.
Right.
Now, it's quite amazing that Evor and I are doing this video here today because Evor did ask his Genovese grandmother. I've got a guy that I'm going to go hang out with today who's Napolitano. His family's from Naples. Can I hang out with him? And, of course, his grandmother's Genovese. And she said, absolutely not. So how did you supersede your grandmother's wishes and actually hang out with me today?
I told her I'd be with a Genovese.
Oh, okay. You lied to your grandmother. You know, all that said, let's just say that if you're going to have somebody taking care of your money and they're Italian, they should be Genovese.
Good point. Yeah, I agree.
Very good. So, yes, we are broadcasting from Inglenook Winery in Rutherford. Today we're sampling some flagship Rubicon 2010 in my little demi bottles. We don't want to overdo it. You know, it's a little bottle.
Yet.
Want a little bottle, a little tiny bottle. So let's talk about some financial planning basics, and I think we'll start with the pig and the python. Mm-hmm. You know what the pig and the python is?
I sure do.
The pig and the python, and the pig and the python. The pig, there's the python, there's the pig, and the pig and the python is the baby boomers.
Right.
What were they? 80 million baby boomers born between 1946 and 1964.
That's right. Yeah.
That's right.
Yeah, it's about right. And there's also the shadow boom too, which we're experiencing. So
the shadow boomers, 64 to
64 to probably late 70s. So
all right. So
so me included.
Oh, okay. Good.
Yeah.
Good. So let's talk before I get into the real estate aspects of the financial planning. Tell us a little bit about, issues you're finding, things that are on baby boomers' minds, or things that are not on baby boomers' minds that should be on baby boomers' minds.
Sure. So one is just the general sense of financial independence and retirement planning. They're finding they're getting to the stage where, work's getting a little tiresome. They want to kind of get out. They're looking at their parents aging, and what do we do? How do we make sure that we're going to be okay later in life and we have sufficient funds, and we're doing all that we can to make our money work as well as as it can for us, that we're paying as little in taxes as we can, and that we are not exposing ourselves to risks that we're unaware of. So they come into our office wanting to know the basics are we going to be okay, and how are we going to do this thing called retirement?
Very good. Mo Banitaba, one of my colleagues, realtors, just checked in, and he doesn't need to worry about it because realtors can work until they're 110 years old.
Well, we're finding a lot of that too. People, it's kind of an encore, what we call an encore phase of the retirement, or an encore career. And it doesn't have to be something where you're earning a ton of money. It's done just for the passion. It's done for fulfillment. It's done to stay relevant. But oftentimes, you don't have to be making six figures or up. It's something that where people are just passionate about what they're doing, and they want to stay fulfilled.
Well, just a couple of weeks ago, I did a video blog with Nelson Staffing, Chris Allen, talking about quote-unquote retirement in wine country with a second career in a tasting room.
Sure.
You like the wine already, you might as well get the wholesale deal.
Well. Yeah.
And, I do find that people that are quote-unquote retired do get a little bored.
Sure.
And maybe are a little cash flow challenged, where they certainly can afford to be retired, but they can't afford maybe to take as many trips, go out to dinner as much, buy as much fine wine. Can you talk a little bit about being retired versus being retired and living the life that you want to live?
Sure. Well, we see a lot of people entering retirement and going through a couple of phases psychologically. They've come out of this accumulation phase while they're working, where earnings are going, their accounts are being built up, and they're increasing in value. And now they retire, and they find taking money out is just unnatural for them. So we're not saving anymore. So a question and a concern that comes up is, so how do we just live off the interest and the dividends of our portfolio?
Oh, your client Peter Malley is watching, and he is now retired.
Hey, Peter.
Thanks to you.
Thanks for watching, Peter.
I think you mentioned to him he could retire one of two ways, either voluntarily or not so voluntarily.
Right. So that's something that people have to consider, right, is their health. And they enter retirement, and they oftentimes just need to decompress, getting their routine to where they wake up and they don't have a boss to report to, or they don't have a project that's due the next week. Yeah. So decompressing usually can last anywhere from a week to a year or more.
So let's talk a little bit about pace and bandwidth for retirees. Like my good friend Alex Creel, the head lobbyist at the California Association of Realtors, just decided to, quote-unquote, retire, even though I threw my arms around his ankles and wouldn't let him leave the last set of meetings, asking him, please do not retire, Alex.
Sure.
And I do believe, this is not verified, but I do believe that he might still be maintaining a little bit of a consulting assignment so we could partake of his 40 years, 35 years of experience and contacts. Do you see that as an option with people who are retiring but doing consulting?
Perfect example. Yeah, a lot of opportunities in doing that. Establishing and having your own business, fulfilling, you can have your own schedule, you can earn money at your pace, and oftentimes, too, people can do it anywhere. As we're seeing as a result of the coronavirus, people are becoming more adept at and used to working virtually. So I have clients that work all over as consultants in their retirement. And what the financial planning process helps you do is determine, one, whether or not you even need to earn income, and two, if you're going to, what do you want to do? How are you going to do it? How are you going to fill your time? And how can you take advantage of that from, a tax perspective, especially?
Yeah,
okay, so,
I see that Peter is vouching for you online. I think he might be angling for a bottle of wine. What do you think? and he doesn't want a bottle of Zinfandel. He wants a bottle of the Rubicon.
Sure, I'm sure.
Peter, could you submit your request for which wine you want Evor to bring you so we can shake him down?
I'll give you my best $2 check.
There you go. So, okay, so bringing it down to and around real estate, let's talk about, with baby boomers, how should they be holding title to their property?
So a couple of ways. We commonly see, and it's the correct way to do it, it's jointly with their spouse and in trust. So the joint tenancy with right of survivorship allows, if one person passes away, the property transfers over to the joint owner without any headache or probate or anything like that.
And could you impart to us how joint tenancy with the right of survivorship compares to community property with the right of survivorship in terms of not only the right of survivorship but the stepped-up basis? Can you explain to the audience how stepped-up basis works?
Sure. So a step-up in basis occurs where one of the partners in the joint tenancy or the marriage passes away, and it's if you bought the house at a certain basis, usually it's pretty low.
Yeah, you bought the house in 1973 in Saratoga for $67,000,
right,
and now it's worth $3 million.
Right.
Okay.
So you get a step up in basis to the valuation on the date of death.
So the surviving joint tenant then could sell that property shortly thereafter and pay capital gains taxes on the difference between the stepped-up basis, $3 million, and the sales price, not the difference between the original purchase price plus whatever improvements they put in, thereby saving probably close to $1 million in taxes.
Easily, right. And consider, too, that's right, John. And consider, too, that you have a $500,000 exclusion. So you can pay no taxes for a personal residence if you do it that way. So that's something to consider.
Oh, by the way, I have good news for you.
What's that?
Peter is turning the tables on us, and he's bringing you a bottle of wine. So he must be extremely happy.
And now he's gonna...
Well, we have to. We'll see how happy he is based upon what wine he brings you. A lot of pressure on you now, Peter. Okay, so I want to really punctuate that because
Sure.
if people do not hold the property in title properly, it's a disaster when they sell it and they don't have the stepped-up basis. So let's just review that one more time. Should they hold it as joint tenants or community property or either?
Well, I think it's normally joint tenancy, and that's kind of how you'd want to hold it.
Joint tenancy.
If you don't have a trust.
If you don't have a trust.
Right. We recommend almost everyone, if they own a home, should get a trust.
Okay.
If you have a trust, the title should reflect the title of the trust.
Okay.
Right?
And what kind of a trust will they be initiating?
Usually, both couples, for married couples who are living in both lucid, it's a revocable living trust. So that is something where you are the owners of the trust. The trust has one of the partner's social security numbers. It's very simple. It just gets titled to the trust. Taxes are paid as individuals, and it's very simple.
Okay. So let's go with that theme of highly appreciated primary residence for baby boomers.
Right.
And let's add another context to the theme. Let's say that those baby boomers have Social Security, they have a decent retirement, but they're not flush. Okay, they're not flush.
Sure.
So let's talk about ADUs and junior ADUs. Now, an ADU, and you've seen me write about this a lot, vlog on it a little bit, accessory dwelling units. Over the past couple of years, the governor's office, the California State Legislature, Assembly, and Senate has passed a series of bills pretty much rendering all R1 lots that meet a certain minimum to be able to put an accessory dwelling unit on that property. And it also allows them to do junior accessory dwelling units. Now, from my understanding, and if you go california.gov/ADU, they've got very robust website on ADUs. I believe the maximum ADU is 1,200 square feet or 50% of the main structure. So if it's 2,400 square feet, you get 1,200 square feet. And then I believe you can also carve out a junior ADU of 500 square feet, which has to be attached to the house.
Okay.
Does that sound about right to you?
I don't know, John.
I think that's about right. I think it's about right. Based upon my conversations with contractors, that has been it. So have the ADUs come up within the context of, number one, housing extended family, number two, housing caretakers, number three, creating cash flow? Have those conversations been engaged?
Yes, yeah. And as well, just renting a room out in the home has become somewhat of a thing too, which is a good way to just earn a little bit more income. If you're not flush or you're feeling insecure about the cash flow, sometimes renting a room. The thing you want to be aware of when you rent a room out in the home or you have an ADU is that you are covered appropriately with your homeowner's insurance. That's something that we see commonly with clients, is that they are underinsured, and it leaves one of their biggest assets in terms of home equity largely exposed to loss.
So that's simply a phone call to your insurance agent and advising them that you're either having a tenant rent a room or an ADU or a junior ADU.
Correct. Yeah. The other thing too, which you talked about trusts earlier, and
Yes.
if your house is titled into a trust, something we never see is you should add the trust as an additional insured onto your homeowner's policy. And the reason why is the assets are funded into the trust, so the trust has the asset, which is,
Okay.
that's the useful part. But you want to have your homeowner's policy reflect that the trust is an additional insured, because the trust is kind of like a person in
Yeah.
a way. It's an entity. And so you want to make sure that if you get sued, that you have a good, healthy umbrella policy, and that your trust is an additional insured onto your homeowners, so that if you do get sued, they can help. The insurance company will cover your trust too. Right?
Okay, good.
Yeah.
Okay, so with the ADUs, have these been mostly conversations, or have you seen homeowners pulling the trigger and actually building ADUs and junior ADUs?
It's mostly a conversation at this point.
Yeah, it
I
hasn't
think
gained
it's
a lot of
still
traction
new.
yet. Yeah.
Yeah, I think it's still pretty new, and they're exploring it. And there are a number of great kits that I've seen come across. Contractors are now offering this as a business where they have a kind of a developed structure. You can do this online. You can order kits where they come, and you can have a construction crew basically piece together the walls and put a roof on it. And
All I need is an island, a good burner, and a good bar with some Lagavulin 16, and a front porch to smoke cigars, and a speaker system to listen to Miles Davis.
oh, cheers to that.
You know, that's all I need.
Yeah.
That's all I need. And Bill Phillips just tuned in. Hey, Bill, why don't you come up to Inglenook sometime, enjoy some of this good Cabernet Sauvignon, and we could do a vlog on all things financing. Bill is a good lender over in Willow Glen. Thanks for tuning in. And I see Keith Reber is checking in. I think I've met about 137 members of the Reber clan. Hi, Keith. Say hi to everybody. It's the Irish, you know.
Oh, right.
Lots of reproduction.
I just found out I'm about 10% Irish.
You're 10%
yeah,
Irish.
Yeah,
You're not
I did
nearly
the ancestry.
You're not nearly sarcastic enough.
Well, I haven't had enough of this yet.
Got to keep working on that. Okay, so anyway, for those of you that are thinking about the ADUs, please feel free to contact me. I've got a lot of good contacts on how to properly build them, how to get them permitted, and I think it is the biggest opportunity I've seen in real estate since I got my license in February of 1974. Now, let me throw another scenario out on you. Okay, so let's say you have a small mortgage on the house, you know,
Sure.
a couple $100,000. You're still paying your insurance premium. You're still paying your property taxes. You have your retirement, but again, you're a little squeezed. Even though you got $2-3 million worth equity, you're still squeezed on your cash flow. You know, one of the concepts that I've been advocating is either selling that property and buying a suitable property to build ADUs, get your family compound, get your income, or doing it on your main structure. So can you impart to us your viewpoints on reverse mortgages, particularly as they may facilitate and enable you to build some income-producing ADUs and junior ADUs on your property?
Sure. So reverse mortgages kind of have a bad reputation. And, you know, if I can do anything today, I want to dispel the reputation. It's not as bad a thing as people think. Where they came from, it was a highly sold product. It was something that I think was, then the government kind of came in, regulated it, really controlled the market appropriately this time. Reverse mortgage is a great way, I think, to free up some of that cash flow that you're paying in property tax, the mortgage payment. As well, it will allow you to do an ADU to increase some of that cash flow, and then it would also, maybe save you on some of the taxes. If you have a big capital gains tax, in your example earlier, if you had a $67,000 property that you bought in Saratoga and now it's worth $3 million, selling that is going to be a huge tax liability that will come on your books in 1 year. So it's a reverse mortgage allows you to tap into some of that equity, possibly develop the ADU, get out of that mortgage. You don't have to pay, and then you also don't, since you're not selling the property, you're not going to incur the capital gains tax. So you can really leave it for your heirs. You can do this with your parents too. If you have older parents or a property that you're going to inherit, we oftentimes encourage holding off on the sale until after passing. If you need to do a reverse mortgage, you can do that, and then you get a stepped-up basis after death, and you don't have to pay any tax at all. So in theory, if you needed money out of this high or low-cost basis home, you can tap into the equity through a reverse mortgage and not have to ever pay any capital gains tax.
Very good. You did mention, Evor, that in addition to being Genovese, you were 10% Irish, and my good friend Larry Malone from Bishop Ford High School, circa 1965, 1969, where me and him and Mulligan and McLean and Sheedy and McLaughlin terrorized every bar on every corner between 65th Street and 95th Street and between 3rd, 4th, and 5th Avenue. How are you, Larry? Good times. If you remember the 60s, you weren't there. So let's go a little bit further with that reverse mortgage ADU thing. So, if you've got a couple $100,000 mortgage on a $3 million house, you could easily have a payment of $2,000 a month, which is going to be a big nut if you're on a limited income.
Right.
And if you can do a reverse mortgage and not be required to service the debt, your principal and interest payment goes to zero.
Right.
And it doesn't take much to figure out if you built a 1,200 square foot ADU, especially in Silicon Valley, and a 500 square foot junior ADU. The junior ADU, brand new construction, you probably get $2,500 a month for. The 1,200 square foot brand new 2-bedroom, 2-bath, fully wired, brand new, you could probably get $4,500 a month. New math, old math, that's $84,000 a year in income.
Sure.
And you're not paying $2,000 a month. You've just turned your cash flow around $100,000 a year, and now you could live La Dolce Vita. Am I imagining things, or is that a true picture?
That's a possibility, for sure. The other thing to consider, too, is that most people will not itemize ever again because married couple, they now have a standard deduction of at least $24,000, probably $25,000 in 2020, I'd say. And so the mortgage interest deduction is going away for a lot of mortgage balances that are really under $250,000, $350,000.
So it makes sense to have a reverse mortgage and defer the interest.
Correct. Yeah. Mm-hmm. So it's the mortgage balance will increase, the reverse mortgage as you age, but you can annuitize that so that you get a fixed income stream. So you're not just taking out a big reverse mortgage all at once.
I see Ellen is watching, my wife.
Hi, Ellen.
Yeah. We're going to have to make her think that we're really working.
We are really working.
Yeah. But we're sitting here in England drinking wine. I told her I was going to be working real hard today. Ellen, do not think that just because we're having fun, we're not working. Okay? So let's take again this situation with the baby boomers.
Right.
Now, if you've got that $3 million Saratoga house where you bought it for $67,000 and say you put $133,000 into it, so your basis is $200,000. So if you sell it, you've got a $2.8 million gain. Right. Minus the $500,000 exclusion.
Okay, yeah.
So that's a $2.3 million gain. Right. Off the top of your head, using the new math and the old math, what do you think the taxes due on that is within $100,000?
Yeah. So.
Yeah.
I don't.
The answer is
it's gonna hurt.
It's gonna hurt. It's gonna be painful.
It's gonna hurt.
It's gonna hurt.
Keep in mind, people think that. They think 15% capital gains tax. No.
Mm-hmm.
When you get up beyond $450,000, you get a 20% capital gains tax on the federal side. Then you have the Medicare surtax, which adds another 2.3. And then California, if you live in California and your home is in California, you will also pay ordinary income tax on capital gains in the state of California.
So that's about 13%?
At that level, yeah. So
13 plus 2 plus 20 is 35%.
Right.
So about 1/3.
You'll be paying at least.
So that's close to $1 million, $900,000, $1 million.
Right.
Okay.
So you're paying, you're starting to approach 40%.
Okay. Right. So basically, the answer that I get to people that the house has got a lot of accumulated maintenance. Right. The roof needs to be replaced. The kitchen needs to be remodeled. The bathrooms need to be remodeled. The windows need to be replaced. They don't have the cash flow to do that. And they're saying that the only way I am going to be taking out of this house is feet first. Okay. Okay, kind of like horizontal, like on a stretcher. Right. You know that concept? Okay.
Yeah.
Okay, so let's talk about a way where they may not be perpetually entombed in that house. So let me, as a real estate broker, let me talk about a couple of techniques that I might impart to them. Mm-hmm. Number one, put a tenant in the property and hold it for 2 tax cycles. Put a tenant in it in December, mm-hmm. so you have it on 1 taxable the entire next year, and then through January, 14 months, it's on 3 tax returns. And then I think you would qualify for a 1031 tax-deferred exchange. Don't you think so?
You could do that, yeah. Now keep in mind, too, it's a tax-deferred exchange, right? So you don't have to, if you sold it, you would still have to pay a part of the capital gains that you incurred on the house. But you're right. You could do a 1031 tax-free exchange. We advise 2 tax cycles.
Oh, but Grasshopper, I'm not done.
Okay.
I'm not done.
Well, continue.
Okay, so you take this $3 million house with a $200,000 mortgage on it, say, and you do a 1031 tax-deferred exchange. And let's say you trade it into 4 houses.
Okay.
Okay. Mm-hmm. So you put tenants in all 4 of those houses. Okay. And now you've got the buoyancy of increasing rents.
Sure.
Okay. And you leave a tenant in the house that you have ID'd as your retirement house.
Right.
Let's say it's new construction.
Sure.
Okay. So you leave the tenant in there for a year, year and a half, 2 years. Right. Then you move in, you take owner occupancy of that. Mm. So now you've traded down. Yeah. You've used 100% of your equity to buy 3 other properties plus your house, and you haven't triggered a taxable event.
Not yet.
Not yet. Okay. Right. All right. So, but so far so good, because you're generating income on the equity and on the rental properties, and you haven't paid $1 million in taxes.
Correct.
Okay.
Right.
All right.
Right.
Now,
there's one caveat to that.
Okay.
You want to make sure with your accountant or tax professional that if you were to sell out of the house, that the IRS isn't going to ask for the capital gains from the time that you were occupied the house as your personal residence.
Explain that to me, because I'm not familiar with that concept.
Right. So when you do a 1031 tax-free exchange, you put it in service.
Tax deferred.
Right.
Tax
deferred exchange. Thank you, John. You put it in service at a certain date, and what I want our audience to be aware of is if they do a 1031 tax-free exchange or tax-deferred exchange, that the IRS isn't going to come back to them and ask for accumulated appreciation over the time that the house was personally owned. I don't think they do, but with the new tax laws, I always say,
check.
Sure, check.
Just
double check. This is a big transaction.
Yeah.
You don't want to be caught off guard.
Right. I have never heard of that happening. I'm not saying.
Either.
Yeah. Okay.
Yeah.
All right. So now let's play it out a little bit further. Now let's say with that $750,000 house that you occupy, you, in the meantime, construct an ADU and a junior ADU.
building on it. Yeah.
Okay,
Yeah,
so
absolutely.
that's
Yeah.
more reason.
Right.
Now, let's say you live in that property for 2-3 years. Can you take your exclusion again?
Yes. You have to live in the house for 2 out of the last 5.
Okay, so you live in for 2 years and you're good?
You're good.
Okay, so, here's the next question. This is pretty advanced real estate right here. Let's say you sell that one house after living there for 2 years.
Okay.
You sell it tax-free, except for you take your $500,000 exclusion as a married couple.
Right.
If you took depreciation, you have to recapture the depreciation.
That's right.
Okay, and now you move into the second rental.
Uh-huh.
You give the tenant notice. Can you live in that rental for 2 years and then take the $500,000 exclusion again?
I'm going to have to defer to your tax account.
I think yes. I think yes. I think yes. I
Yeah.
think you can.
Yeah,
But
I would say, yeah, you could explore it as an option first. But yeah, I think you can do that.
yeah. So the point is that there are options here.
Right.
Okay. So I think we've beaten the 1031 tax deferred exchange option to death. So now let's go to an installment sale. You ever do any? You ever see any installment sales?
I haven't done any personally. But,
I haven't seen them. Basically, you sell the $3 million property
Right.
with the $2.8 million gain,
Right.
and you take a 29% down payment or whatever it is,
Right.
and they pay you 4% interest
Right.
over a period of years, and you don't pay the taxes on the income until you receive it.
Correct. Right.
So you're getting interest on the entire amount of equity,
Right.
not on the part diminished by 35% taxes.
Right.
So, realistically speaking, it's a tool. I don't see it used that often. And there's nothing you could do to prevent the new home buyer from paying you off early.
That's correct.
And if they pay you off early, then that triggers a massive taxable event.
Well, the idea is to put the proceeds into kind of an escrow account, and they pay you out incrementally.
Mm-hmm.
And then you take, let's say it's over 5 years, you would divide the profit, the taxable profit,
Right.
over the 5 years. So,
Right. But my point is, if they do decide to sell the property and pay you off prematurely, the most you can hope for is a prepayment penalty,
Right.
which is going to pale in comparison to a huge tax liability.
Tax liability
If
would
they pay you
probably
early.
trump that, yeah.
So, whereas an installment sale is an alternative and a possibility for loosening up huge taxable capital gains on the sale of a house, it's not necessarily at the top of the list, but it's important for you to understand that that's there. Now, one thing that you can help me with, Evor, is something called structured sales, where you get an institution to buy the installment sale.
That's
Can
what
you tell me
yeah.
about that? How does that work?
So the structured sale, you sell the house, the proceeds, as mentioned before.
Yeah.
I think that we might have been mentioning the same thing, but the proceeds go into the structured sale. It's like an escrow account.
It goes to like Prudential or some
Correct. Right.
big organization.
Right. They hold the money, they divvy it out over a number of years, and then you're paid on that income coming in based on the capital gains and proceeds coming out of it.
And they customize that kind of like, for lack of a better word, an annuity.
Correct. Right.
Okay. Now, the return on those quote-unquote annuities is spit. I mean, they're probably...
You're not doing it for the return. You're doing it for the tax avoidance.
So you're saving the 35%.
Correct. Right.
Which is a big number.
It's a big number. You just have to be conscious of what you're already getting. So if you're getting Social Security, if you're getting a pension, if you're getting required minimum distributions, or just distributions from an IRA, there are a lot of sources of income that people don't realize they have, even after they retire. So just be aware of that before you get into these things. You really want to map this out over the next 5 years.
Well, the good thing about the structured sales are that you can sit down with the entity, and if I remember, what is it, New York Life, Prudential,
So the big,
the big ones are in this marketplace,
Right.
and they will actually structure the structured sale
Right.
exactly the way you want it, right?
Yeah, up to certain limits. I'm not sure what the limits are, but they will. There is some freedom and flexibility
Yeah.
to these, so it's not a bad idea.
Now, if you were going to use that, everybody's situation is different. Do you think people would be taking 20% of their equity, 30%, throwing the rest into structured sale, or is there any rhyme or reason to how they would allocate the cash that they get out of the sale and the structured sale?
Well, ideally it would be coordinated with your other income streams, so that you aren't breaching any of the tax brackets or some of the limitations that are inherent to your own tax situation. So you're not paying more. The idea is to kind of lower the taxes.
Right.
So you just want to be aware of it. So it might be 10%, it might be 30%. You can sit down with the structured settlement people,
Yeah.
and kind of hammer that out. I always advise, though, that you really bring a tax return. Make sure you understand what your income is and what it's going to be in the next 5 years.
Right. So, again, modeling this,
Yeah.
we talked about 35% for state, Social Security, federal long-term capital gains taxes.
Sure.
So let's say you sell a $3 million property and you have a $3 million gain, just for simple purposes. So if you took $1 million, that might be subject to the 35%. So you give up $350,000 in taxes.
Right.
You take $650 net cash, and then the other $2 million you plow into the structured sale, and maybe you can set that up to pay you $10,000 a month, $15,000 a month, $5,000 a month, or whatever, right?
Whatever they allow,
Okay.
and within whatever time frame, right? So
Do you have any idea of what the minimum and maximum time frame could be?
I don't, yeah,
I got to think it's pretty flexible.
yeah.
Yeah, go ahead.
Yeah, I think that I've heard 5 years being the amount. If it goes up to 10 years, I think that might be a good thing as well. It could be useful, right? If you can spread it out over 10 years, that would be.
Are you still paying the 35% long-term capital gain on the allocation, or does it go down because you're dropping yourself into a lower bracket?
That's right.
Year by year.
The idea is to drop yourself into a lower bracket, to drop yourself into the 15% bracket for federal, and then, if you're leaving the state of California, you'd also drop another 11, 12, 13%.
Oh, that's
state
interesting.
tax.
So you combine it with moving to Nevada.
Right. So
That's
move to a low or no state tax area, and you can really drop your taxes down. We always encourage people, make sure you understand what the bracket is, where the 15% federal capital gains tax cutoff is, and then how much you're paying in state tax, which again, California taxes capital gains as ordinary income. So it's the same tax structure.
That's huge. So
Yeah.
maybe you take out enough cash, net cash, to buy a property that you could build an ADU and a junior ADU on, and then plow the rest of it into the structured sale. And now you got income from the ADU, the junior ADU, and the structured sale.
Right.
I mean, before you know it, you could be $15,000, $20,000 a month.
Yeah.
Yeah.
Right.
So,
Right.
so anyway, another tool. So, have we forgotten anything about baby boomers, or did we cover most of the things that come up?
One of the other things that comes up is moving, right? People have become accustomed to living in this big house with the kids around. They've kind of the house is outgrown them, so to speak. And now they're empty nesters, and they might live in a 3, 4, 5 bedroom house that they just don't need all that space, and they want to explore what it means to move. And we often say, go ahead and explore what it means to rent the house out and move and rent somewhere else for a little while to explore the area, or you can go ahead and you're generating income. The income from the rental supports your new lifestyle somewhere else. So you can buy something somewhere else or rent somewhere else.
Or you can take that big property with the big equity,
Right.
do a reverse mortgage on it. I think a reverse mortgage will allow you to turn it into a rental, but you got to pay it off after a year. That could give you the cash to buy a replacement residence, move into it,
Right.
and then you sell the property a year later, presumably on a 1031 tax-deferred exchange.
Yes, if you rent the house out, the 1031
Yes.
apply to rentals. Just people need to understand that.
Right.
They apply to rentals, but yeah, the reverse mortgage it would allow that, so that's a good idea. And then, but you have to be living in the house in order for the reverse mortgage to stay there long term.
It is a little tricky. I think
right.
the provisions on the reverse mortgage are that you have to be there, you have to live
Right,
there,
right.
And then if you move out, you have to pay it off within a year.
Correct.
Okay.
Right. So it allows that bridge, that
Yes.
time where you're exploring and figuring out what you want to do with the next phase of your life.
Okay, so let's talk about a real issue that I run into. It's not that uncommon where I'll have a conversation with people about this, where you have hundreds of thousands of dollars at stake, if not $1 million plus, and it's like, this is giving me a headache. I don't want to even think about it, and they wind up making a poor decision because it's too hard to think about.
Right.
Can you help us bridge that gap?
So if you find that it's overwhelming you, seek outside support. It's not that hard. You go to your tax professional, go to your financial advisor, form a team. Your realtor, your estate planner, your tax professional, financial advisor, and put the problem onto their plate. Let us do our job. That's what we're here for. We'll map it out for you so we can reduce this into simple, easy to understand bits of information where you can make that decision and good, excellent decision support. So you can make these decisions with your eyes wide open and not get dinged or not do something that is irreversible.
Okay, and should they do that like 3 days before their escrow closes or a year before their escrow closes?
A year.
A year.
Do the year.
You don't like the 3 days before the escrow
I can't
closes?
do anything for you 3 days before much of anything.
All right, so if you're going to take 100%
Right.
and say of 100%, this percent will do the planning well in advance versus this percent will come to me like at the 11th hour in a panic saying, I got a problem.
Yeah.
How does that break down?
I think it's the Pareto principle, the 80-20.
Oh, is it the 80-20?
The 80-20.
And who's the 80 and who's the 20?
The 80-20, the 80 is the percent that don't do anything.
All right, so don't feel like you're by yourself.
Don't beat yourselves up. Most decisions are made kind of in haste. I encourage everyone, though, to just take your time, be calm, and get a good team together. Get a second opinion.
Well, there's a lot at stake here. I mean, people are living longer. Especially if you're in the Bay Area, there's so much to enjoy in the Bay Area.
Sure.
And, doing a self-sequestering of yourself where you imprison yourself financially and physically in your house because this is all too complicated and you don't want to think about it. I mean, that's a stiff sentence to impose upon yourself.
People oftentimes stay in the house because they're familiar with it. It's a scary thing to pack up and move or even think about it. And it's a decision that we don't take lightly for any of our clients. So what we want to do is map it out, but also give the process ample time to have clients marinate on this decision, think about it. And sometimes clients do it for years. And they don't pull the trigger on a house for years because it's an emotional thing. There's a lot of memories and emotional tie into a house. And we never push clients to do this, which is a good thing because we want them to make a well-informed decision that they're comfortable with, and that we've seen all the different angles and the opportunities that people maybe haven't thought about before.
I can see you're like that old sweater I don't want to give up. You're so comfortable in your approach.
It's hopefully not the ugly Christmas sweater. But
No, not that one.
people usually like to think that they can do it, and they don't want to think about it. They give up, and then they just say, never mind, I'm going to do this, either stay in place or I'm going to sell it, I'm going to move, and then they get hit with the taxes, and they don't understand how much the taxes can be.
Right, and I think it's important when you're selecting a realtor to have this conversation, because people are real concerned over whether they sell the house for 2.8 or 2.9, but then they don't pay any attention to the difference between paying zero in income taxes or $900,000 in income taxes.
Right.
What kind of sense does that make?
Yeah, none. So yeah, we often say, look, it's the same thing with investments. If you make 20% a year on your investments, but you have to pay a 30% capital gains collectively tax between federal and state, is there a way to maybe improve that overall rate of return by maybe just employing a few tweaks to the strategy? Same thing with property. Always talk to the realtor. Always talk to your financial advisor, tax professional.
Very good. Well, it seems like we focused on the baby boomers today.
Yeah, I think,
But they deserve to be focused on.
They're a good group.
They control all the wealth for the most part.
They do.
Except for the 19-year-old that went public and made that new app
Sure.
for Samsung and Apple.
Right. Same story. Yeah.
That's right. So remind us, how do people get a hold of you, Evor?
So we can be reached at our website, www.aspire-planning.com. You type in my name, Evor, onto Google, and it will probably pop up.
He's the only one. He's the only one. That's right. And, I do feel compelled, Evor, since I'm Napolitano and you're Genovese, to tell my story of when I first moved out to California. Now, were you born in San Jose?
I was, yeah.
You were born in San Jose? So when I first came out to Sunnyvale in 1973, I called my father and I said, Dad, there's a lot of Italians out in this area, but they're different. They're different.
Right.
They're not Neapolitans.
No, they're not.
Right. And I don't even think they remember who their relatives were that came from Italy.
No.
And when they came from Italy.
Right.
I think they came from Italy during the Civil War.
Yeah.
And they eat something called polenta.
Right.
I think that we call them the palantone, the polenta eaters.
Right.
And my father says to me with his typical Neapolitan attitude, Johnny, in Napoli we feed the polenta to the chickens. So you got to up your game, Evor. You got to have some rigatoni with a Sunday sauce, some linguine and clams.
Well, it's in California. Some of the dogs eat better than the human beings out here.
Well,
so,
it is.
It's a high bar.
A dilemma wrapped in a conundrum. So we can continue to talk, but we're just having too much fun. And you know what? I think we may have tasting inside the chateau ready to go.
Okay.
So I have a YouTube channel. Try John Pinto, John V. Pinto. And as much as I enjoy all this video blogging, believe it or not, I make my living as a realtor. 46 years, 4,000 transactions. If you or anyone you know are looking to buy, sell, exchange any real estate in the greater Bay Area, please let me know. And of course, we will have our strategy meeting on the patio at Inglenook Chateau and Winery, the Luxembourg Reproduction Gardens, over a glass of Cabernet Sauvignon. So if you need anything from me, just message me on Facebook or find me any variety of ways. Do you have any concluding remarks for our viewing audience, Evor?
Just to, especially in these times, try and remain calm. I know with the market volatility, people are getting a little nervous. But if you have a well thought out investment strategy, just stay the course for now. Expect more volatility, but just know that we'll pull through this. So we're encouraging people to call their advisors or look at their portfolios and maybe think about some rebalancing.
That's right. And we will be doing some shorter videos. I'll be visiting Evor at his Walnut Creek office because I do have to go to the Nespresso boutique and exchange my old machine for a new machine. So that's a good excuse to come and see you over there. Very good. So thanks for looking, and we'll see you on the next vlog.